Chief Financial Officer with L&T, joins us to discuss numbers and how things have transpired for the quarter gone by. Good morning. Thank you for joining us. Now, despite over 20% growth in H1, you've maintained your guidance and your order guidance on revenue order flow. Are you being slightly conservative here? Because if you're growing at that run rate, you're on course to actually beat your guidance.
You know, in project business, the orders tend to be lumpy. And given the size of the orders, there is always this possibility of orders slipping between quarters. So it does become tricky to be very precise about these estimation. At the beginning of the year, we had given a range of 12 to 15%. Looking at the way we are placed at the H1 level and looking at the pipeline going forward, it appears that we would be closer to the top end of the guidance band than to the bottom end. Now, if all goes well and gods are kind, possibly we can go beyond. But you know, it is always fraught with the risk of the ordering momentum continuing to be strong in the second half. So it's more being practical rather than unnecessarily speak up the market, and then we would like to possibly under promise and deliver if we can.
Okay, so under promise and over deliver, that's been the motto at L&T as it is. But what about the margin picture? Because in your press conference, you talked about how the margins are likely to be towards the lower end of the range at around that 9.5% mark. Why the muted commentary? And this is coming despite the benefit of commodity softness that we're expecting in the second half.
Anisha, in our business, the order placement and the procurement cycles, especially for long lead items, stretch to somewhere between 12 to 18 months, depending on the type of the equipment that we order and the type of material that we order. So most of the orders that we have placed in the previous year are getting into the consumption mode in the current year and hence are costed out in our profit and loss statement. I do believe, given the length of the project ranging between 30 to 40 months on an average for our order book, the consumption of high cost material procurement to continue for some more time in the current year. The benefit of softer prices in the last few months, and hopefully if it stays that way going forward, the benefit of placing procurement orders at these price points will actually play out as margin levers in the subsequent, maybe the last quarter of this year or the first couple of quarters of the following year. So there is always this lead lag between the time we place orders for procurement and the time that we consume. So you have to factor that when we guide you on the margins.
Sure. Mr. Shankar Raman, you mentioned that order momentum has been strong, but give us a little bit more insight on this. Which segments are driving order inflows? And also, is public sector Capex now overshadowing private, or is seeing a pickup in private Capex as well?
Quite to the contrary, because a few large private sector orders actually tilt the ratios. Let me address this in two parts. One is the general Capex. I think about 6 lakh crore worth of orders were tendered out during the first half of this current year, and nearly 3 lakh crore worth of orders have been awarded. So about 50% is the strike rate for the order tendered to awards, which is fairly healthy, I must say. But when it comes to actually who spends this, the Government of India, between the state, center and PSUs, had a budget, or do have a budget this year, of about 21 lakh crore of Capex. Roughly, they are 7 lakh crore for the center and 7 apiece for the PSUs and the state governments. The center Capex and the PSU Capex have been running at the rate of 30% so far up to the current year, and the state has been lagging behind at about 20%. So the overall consumption of the planned Capex is about 27-28%. Normally, in our experience, the second half of the fiscal, these ratios pick speed, and the governments and whether it's state or center or PSUs are keen to exhaust the budgets that they have sought for from their respective authorities and like to approach the next year with a fresh set of budget. So I do expect the momentum to actually pick speed. Of course, the major consideration in all of this is the ability of the state government finances and their own execution pace. That has to pick speed. The center and the PSUs have sort of gotten over that hesitancy, as we can see from the first half of the year. But the second half of the year, the states will have to come to party. And if they do that, I think there is a good chance of the order consumption of the budget going up from the 27-28% now to possibly about 70-75%.
Mr. Raman, I want to now talk to you about L&T and a sector which is being spoken so much about, defense. We know L&T has large ambitions when it comes to defense. At the Defense Expo, in fact, the L&T booth was one of the most sought after. What's the larger game plan? What kind of revenue contribution can come from defense for L&T?
Internally, we keep joking that defense has been a startup business for now almost 25 years. There has been a gap between the capabilities that we as a company have mastered over the past 25 years and the quantum of business. The business has not scaled up, but I must mention that it is very refreshing to note that the government is beginning to look at defense, especially the domestic manufacturing aspect of the defense, more closely than ever. The policy initiatives are moving in the right direction. So is the procurement program. We need to make sure that the import dependence that is very high in case of defense actually comes down. My sense is it will take 2-3 years for the domestic capability, talking beyond L&T, the domestic industrial capability to stabilize for the government to feel confident about sourcing critical equipments from the defense industry. But coming back to L&T, I think L&T has exceptional capabilities in the area of supplies to Army and Navy. And we've been working with the government, MOD, DRDO, etc., for many, many years now. So the government does know, the Ministry of Defense does know the technical expertise of our company. We do expect that the business to scale up. Currently, about 2-3% of our order book is what defense constitutes. But if I look at the possibilities going forward over the next 12-18 months, I think this is likely to actually gather pace. I wouldn't be surprised if we move this to 3% and to excess of 5% in about a year's time from now.
Medium-term plan, that is 2026 Lakshya's targets of 2.7 lakh crore revenue and return on capital requirement of 18% and exit of some of the non-core businesses. Are you on track to achieve it?
I think we are taking definitive steps towards reaching the target. The motivation inside of the company for all of us is to make sure that we reach the plans that we have set for ourselves. We're very conscious of the fact that this is our plan and we own it. So we will do everything possible to get there. In terms of scaling up the execution, I think we need to maintain the momentum that we have sort of set out in the current year, going forward over the next 2-3 years. The extremely large order book that we have does provide us this opportunity to attempt that, because we don't have to keep worrying about receiving orders to be able to manage revenue growth. The challenge is obviously going to be the profitability, because all the return ratios that you spoke about would arise from how profitable our execution is. While we are fairly well experienced in this area, the headwinds as they develop to global supply chains and the geopolitical developments are something that we need to keep watching out very closely. Our supply chain is international. We don't procure everything that we require for project business from India. So to that extent, the way the world and the way prediction about the global economy, the energy crisis, etc., plays out will have an implication. But we're trying to work on plan B, plan C, so that we are ready for some eventuality, barring some black swan event. When it comes to return ratios, I think we continue to believe that our EPC business, the core business, and the services business that we run, including the manufacturing, are going to be debt light. There'll be enough cash accruals to be able to support whatever working capital and fixed capital that will be required to service this. So the chances of having to borrow to keep these facilities going or these plants going is very low.
Okay, Mr. Shankar Raman, now don the hat of the doyen of the India infra sector for us and help us understand where are we in the Capex cycle, because we have been talking about the green shoots for a long time, but they fail to materialize. Is the timing right now for India Capex uptrend?
Actually, I am optimistic about it. We've been going wrong in time predicting the timeline though. But if I just sit back and look at the sentiment per se, I think most of the business leaders that we converse with are extremely positive about the prospect in India. I think India shines by its contrast to the global conditions. There's so much of conversation around possible recession, very unsustainable inflation, and the energy crisis, etc., which are on the world scene. But India seems to be very resilient. And I think people are beginning to think about expanding capacity. The commodity prices have been very volatile. And as you would have expected, when the prices were shooting up, I think the commodities which were actually getting the benefit of this price, like steel, capacity addition started happening. Today, as the level of activity at the ground level, represented by, let's say, the infrastructure build out, the cement capacity, the steel capacity, etc., is bound to pick up. They may not be greenfield expansions, but they'll definitely be brownfield expansions. Secondly, the automobile sector is doing very well. I think we do believe that with both the basic demand being strong as well as the EV demand picking speed, with the EV infrastructure rolling out in, let's say, 3 to 5 years, we will see automobile industries as well investing in this capacity. We see IT companies coming back to infrastructure investment in a different manner. Today, I think a lot of cloud services and data center services are being provided from India. So there is fair bit of demand for these kind of facilities to come up. And as we speak, we ourselves are building up a few of the data centers for ourselves as well as some of the leading companies around the world. I do think investment in water, which is mostly in the state and central program, will have to continue to gather pace, because I think water and power, as you know, are basic election issues. And I